Welcome back to Investing Talk Podcast. Today, we are diving into a stack of listener research, and it's all focused on the data center giant, Digital Realty Trust. This is a really critical infrastructure play, right?
Absolutely.
And we're going to spend some time unpacking its fundamentals, looking at the risks. I mean, risks always come with massive scale, and of course, the huge growth story around AI.
Right, and our job here is pretty focused. To take all this info and help you figure out the core question, is Digital Realty Trust actually a good buy right now?
Mm-hmm.
So we'll look at its financial health, its competitive position, technicals, basically help you decide what kind of investment horizon might fit best here.
Okay, perfect. And before we jump in, if you find this analysis helpful, please do remember to subscribe, like, and leave us a comment.
Yeah, definitely helps us out.
And hey, if there's a specific company you want us to look into, just drop it in the comments below. We'll add it to the research list.
Okay.
All right, let's get started. First off, the sheer size of this company.
It's hard to overstate.
It really is. When you look at Digital Realty Trust, you're talking about the largest global data center REIT out there. Our sources show, over 300 facilities?
Yeah, over 300 spread across 6 continents. It's a massive footprint.
And that scale, it really shows up on the top line, doesn't it?
It absolutely does. You look at the 2024 numbers, revenue hit $6.6 billion. That's a big jump from $5.9 billion the year before in 2023.
Wow.
And that growth, it's not trivial. It really reflects that strong demand from, the hyperscalers, enterprise clients, and now increasingly all the needs driven by AI infrastructure.
And profitability, did margins hold up with that kind of growth?
They did pretty well. Net income for 2024 came in at $703 million. That's about a 10.7% net margin. Solid.
Okay, but, since it's a REIT, we got to look beyond just net income, right? What about funds from operations? What's the real cash flow picture?
Exactly. FFO is crucial here, especially for a business this capital intensive. So for 2024, Digital Realty Trust generated $1.93 billion in FFO.
$1.93 billion. Okay.
And that's the number that really supports the dividend. The 2024 dividend was $5.04 per share. If you work that out, it's a payout ratio of around 82% of FFO.
Which is pretty sustainable.
Yeah, that's kind of the sweet spot you look for. Sustainable, but still returning a good chunk to shareholders.
Okay, now I did see some headlines. Something about a huge jump in net income per share in Q2 of this year, 2025, like $2.94 per share. That sounds enormous.
Yeah, that's a classic headline potential trap. You really need to dig into why.
Right.
Our analysis shows that big Q2 number wasn't really from core operations booming unexpectedly. It was mainly driven by one-time gains from selling off some assets.
Asset dispositions. Got it.
Right. So while the cash they raised is obviously good for the balance sheet, you shouldn't mistake it for a new, higher baseline for earnings power going forward. It's more noise than signal for future quarters.
That's really important context. Okay, so let's talk about their competitive edge. Why do customers stick with them? I know the customer base is diverse, which is good. No single client over 10% revenue.
Good risk management there.
But the sources really highlight something called platform digital. What exactly is that, and why does it create, lock-in?
So Platform Digital isn't just renting space. Think of it more as this globally connected ecosystem. It provides high-density power, cooling, and crucially, those low-latency cross-connects between customers within the data centers.
Okay.
Once a big hyperscaler or enterprise builds their critical applications relying on that network density and those fast connections, well, moving becomes incredibly difficult and expensive.
Right, you'd risk performance issues, downtime.
Exactly. Performance hits, huge capital outlay.
Yeah.
It just makes it structurally hard to leave. It effectively locks in that recurring revenue. That's their moat.
Okay, so confirmed scale, sustainable cash flow via FFO, and a strong competitive advantage. But building all this digital infrastructure, it takes a ton of capital. Let's shift to the growth drivers and, how they're paying for it.
Yeah, the outlook is definitely positive, mostly thanks to those big secular trends. Management's guiding for continued mid-single-digit annual growth in revenue and FFO into 2025.
And that's mostly AI and cloud demand.
Almost entirely underpinned by that, yeah. Just relentless expansion demand for cloud and AI infrastructure.
And they're definitely leaning into that AI narrative hard. I saw the launch of their AI Innovation Lab back in September was seen pretty positively by analysts.
It's a smart strategic move. It helps reinforce that story, that their leverage to AI positions them as a key partner for those next-gen high-density computing needs.
Makes sense.
Plus, investors like predictability, right? And Digital Realty currently has a record-high leasing backlog.
Oh, really?
Yeah, which basically gives you strong visibility into future revenue, kind of shields them a bit from short-term economic bumps.
Okay, but capturing that AI growth means spending huge amounts of money, which leads us straight to the risk side, leverage.
That's the elephant in the room, always is with these capital-heavy businesses. They have to carry significant debt to fund growth.
How much are we talking?
Well, as of the end of 2024, total consolidated debt stood at $16.4 billion.
Billion. Okay, that sounds like a lot.
It is, and it puts their net debt to adjusted EBITDA ratio, that key leverage metric, at about 6.0x.
6 times. Wow, how does that compare?
It's high. I mean, it's somewhat common for data center REITs because they're so capital intensive,
Mm.
but it's definitely at the upper end, maybe slightly above the typical REIT range, which is more like 4 to 6x.
So 6.0x, I mean, especially with interest rates where they are or have been, is that level of risk really okay? Or is the market just kind of ignoring it because everyone's excited about AI?
That's basically the core tension for this stock right now. Being a highly leveraged REIT makes digital realty very sensitive, very vulnerable to rising interest rates. That's the #1 risk for the whole sector, really.
Because it makes refinancing more expensive.
It's exactly higher financing costs when they need to roll over that $16.4 billion debt pile. And it also tends to pressure valuation multiples across the board for leveraged companies. Makes them look less attractive relative to lower debt peers.
So the market's just betting AI growth wins out?
Pretty much.
Yeah.
The current bet is that the AI growth trajectory will be strong enough to offset that interest rate pressure. It's a calculated risk investors seem willing to take for now.
Now, he's probably also mentioned the risks that come with just being so global, right?
Yeah.
Especially expanding in places like Europe and Asia Pacific.
Oh, absolutely.
Yeah.
Global expansion brings its own set of challenges. You've got development risks,
Oh.
things like cost overruns or construction delays on big international projects.
Sure.
Plus, the usual suspects, currency fluctuations, geopolitical risks in different regions. Execution risk on these massive projects is always a factor to watch.
Okay, shifting gears a bit, let's look at the stock itself. What are the charts telling us lately? The technical picture.
Well, recently, the shares have been kind of consolidating. Looking back over the past 3 months, the stock's mostly traded in a fairly narrow band, between $130 and $150 per share.
Okay, so defined range.
Yeah, and that gives us pretty clear reference points. Support seems pretty solid, down near $130 to $135. That lines up with some previous lows.
Then resistance?
Resistance looks like it's capping gains, for now, between $148 and $150. So those are the kind of boundaries defining the current trading zone.
But are there signs it might break out of that range? What about momentum?
Actually, yeah, the momentum indicators are showing some positive signs, suggesting maybe it's trying to push higher. The stock is currently trading above its 50-day simple moving average, which is good.
Okay.
And maybe more significantly, there was a positive MCD crossover back in mid-September. Technically, that signals bullish momentum might be building up.
Interesting. Does that technical strength line up with what analysts are saying?
It seems to. According to the source material we reviewed, the analyst consensus is largely buy or overweight.
Pretty positive then.
Yeah, overwhelmingly positive. Price targets seem to be clustered mostly in the $155 to $165 range. So Wall Street sees more upside from here.
And general market sentiment reflects that.
Definitely positive sentiment, yeah.
Yeah.
The market narrative is really focused on the long-term potential from AI and cloud growth. That seems to be the dominant theme.
What about the big money? Are institutional investors buying into that story?
Well, the institutional activity has been described as dynamic, which means there's movement on both sides.
Ah, okay.
We saw one major institutional holder actually trim their stake by about 6%. Could be profit-taking, could be reallocation, who knows.
But others are buying.
Yes. At the same time, other large funds have been significantly increasing their positions. So despite some selling, the overall institutional interest and conviction in that long-term story seem to remain pretty high.
Okay, let's look ahead then. What are the key things coming up that could, move the needle short term?
The next big scheduled event is definitely the Q3 2025 earnings release. That's expected in early November.
And what will investors be watching for there?
2 main things, really. First, they'll want to see confirmation that leasing momentum is still strong. Second, they'll be looking for concrete details on significant AI customer wins. That's what justifies the current valuation.
Right. Proof points for the AI story.
Exactly. And since digital realty is a major REIT, don't forget about index stuff.
Like ETF rebalancing?
Precisely. There are major ETF rebalances scheduled later in November for funds like VNQ, XLRE, those big real estate ETFs. Rebalances can cause huge sometimes purely mechanical, shifts in demand for the stock.
Good point. Any other dates?
Further out, you've got the 13F filing deadlines in December. That's when we'll see exactly where the big institutional money managers place their bets during the third quarter. Always interesting.
Okay. Now, beyond the scheduled stuff, any speculative rumors or catalysts floating around, things that aren't guaranteed but could impact the price?
Yeah, there's always chatter. On the speculative side, the big one right now seems to be about a potential mega-scale AI partnership, maybe with one of the huge cloud providers.
Oh, that might big.
Huge. Landing a deal like that would instantly validate the growth story further and really cement their position as a go-to provider for AI infrastructure.
Makes sense. Any other rumors?
The other main one ties right back to that leverage risk we discussed.
Selling assets.
Exactly.
Yeah.
There are persistent rumors about potential strategic sales of some non-core assets. That would be a really positive catalyst, in my view.
Because it could reduce debt.
Reduce that $16.4 billion debt load, yeah. Or, alternatively, free up capital to reinvest in their core, higher growth development projects. Either way, it directly addresses that key investor concern about leverage.
Okay, so let's try and synthesize all of this. We've got critical infrastructure, undeniable scale, huge AI tailwinds, but also that significant interest rate risk tied to the high leverage. It's a real tension.
It is. So pulling it all together, based on the solid financial health, that strong growth outlook, plus the positive technical signals we're seeing, the overall rating comes out to about a 7.5 out of 10.
7.5 out of 10, so pretty good, but maybe not a screaming buy.
Well, the stock isn't exactly cheap in the traditional sense. It's definitely pricing in a good amount of future growth already. But you could argue that valuation is justified by these really powerful long-term secular tailwinds in cloud and AI. Demand seems pretty locked in.
So what does that mean for someone listening? What's the investment timeline recommendation here?
I think the final outlook really points towards this being better for long-term investment.
Okay. Why long-term specifically?
Because if you try to trade this stock short-term, you're just going to get whipsawed by all the macro noise headlines about the economy, central bank talk, endless speculation about interest rates.
Yeah, that sounds exhausting.
It is. The long-term horizon, though, that's really the best way to capture the benefit of this multi-year, maybe multi-decade build-out of essential data and AI infrastructure. That's the real story here.
That sums it up perfectly, that core tension. Massive AI-driven growth potential balanced against that significant leverage and interest rate sensitivity.
Right. And maybe a final thought for you to consider, something building on the sources.
Yeah.
Think about those rumors we mentioned, but also the idea of index inclusion.
Okay.
What happens if the market starts to fundamentally shift how it views digital realty trust? What if it stops seeing it primarily as a traditional leveraged REIT, valued mostly on FFO multiples?
And start seeing it more like a pure tech infrastructure play, valued more on revenue growth, like a tech company.
Exactly. If that perception shifts, maybe driven by AI dominance or inclusion in tech indices,
Yeah.
that could completely change the valuation game and the stock's long-term potential. It's up to them all over.